He's long been one of the most vocal analysts on Wall Street. Earlier this week, Mike Mayo was one of several US-based employees caught in the wind down by CLSA of its US equity research unit. But he was still there at JP Morgan's Investor Day fewer than 24 hours later. The self-described free agent analyst Mike Mayo joins me now for his first TV appearance since CLSA wound down that unit. And of course, he's the author of Exile on Wall Street and maybe looking to write part 2, Exile from Wall Street at this point, right, Mike?
Well, that was a nice way to say I was fired on Monday night, but that's not going to stop me from doing what I think I do best, and that is advising investors on bank stocks and holding top bank managements accountable for allocating resources correctly and holding them accountable to making sure they do it well. Let's
get to that in a second. Fascinated by your views on banks, especially currently, but on the whole research unit thing, there was a story recently circulating about how analysts that don't get access to management, don't get business and get fired eventually. And the access to management only comes with positive or at least neutral ratings now. I thought that was all done away with. I thought that we had sort of cleaned up the whole analysis area of Wall Street.
Well, I'm proud for having been the only analyst to testify to the U.S. Congress for Sarbanes-Oxley in 2002. And I have a whole testimony saying that if you play ball with corporate management, then you get all sorts of perks. And if you're aggressive against corporate management, you get a stick and you get whacked upside the head. And I'd have to say, for the most part, since 2002, 15 years later, things haven't changed too much. So as much things changed, it's as much as they stay the same. Having said that, I've had enough experience that I'm able to be a bit more aggressive as viewed by others and still be able to do my job. In fact, a lot of times when you don't talk to management, you do much better research. I've done my best research when I don't talk to management at all. So in a way, the lack of access that I've had over 25 years, and it's detailed in my book and the testimony to Congress, has helped make me a better analyst.
Well, so that's fascinating that you don't think anything has changed much. Does that mean that regulations matter not a bit, whether there are more of them or fewer of them, like we may be promised now?
Well, regulation is good, red tape is bad. So, keep the safety and security of the system and get out all the complexity. I mean, as an analyst at a brokerage firm, you have to fill out a paper once every 3 months saying, your views express what you really think they mean. Like, this is just a lot of paperwork. But the reality is, at an era when we're pulling back regulation, it's even more important for investors to hold top corporate managements accountable.
CLSA winding down its U.S. equity research unit. What does that say about the environment as a whole for banks, for research units, for corporations?
JP Morgan had its annual Investor Day on Tuesday, and they are gaining share. The fastest region of growth for JP Morgan is Asia, and they're expanding with equities, fixed income, investment banking, capital markets. So the large global banks that roll out a full spectrum of products are and can gain share. So, and by the way, there's always a role for what I do and others like me. And that is, to the extent that you hold managements accountable to be acting in the shareholders' best interest, that's not going away. It's not going away anytime soon. And there's a lot of encouragement from investors that say, Mike, keep doing what you're doing, especially going to annual meetings, which I'm the only one who I think does that. And they're like, yeah, there's a disconnect between the management and the board of directors.
And you actually told me that you own a little bit of each bank just in order to be able to go to the annual meeting, not for any other reason. Explain to me how much you think the US is going to hold on to its dominance as banking centre. Already we're seeing signs that post-Brexit, Britain might be losing some of that. How long before Asia has the dominance again?
Not too soon. I mean, the US banks, the investment banks, we're talking about Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, and Bank of America, they gained market share last year. And one reason is the US banks have the strongest balance sheet in a generation. So U.S. banks can deploy those balance sheets to facilitate more investor activity. So U.S. banks right now are, in a position of relative strength.
You were super bullish the banks in the 80s and then it turned bearish.
In the
90s,
yes.
Turned bearish. And then last year, it was a major news story. You changed your outlook for the banks. You were very positive again. Now you think there might be a little bit of over-exuberance.
I'd say for the first time in the last year, I'm now saying that perhaps too much of the Trump bump has been priced in. So there's some short-term potential issues, and I think we'll hear two words over the next 7 weeks, and those two words are sector rotation. So first quarter earnings should be pretty good for the banks, but either at the time or before that, I think you'll see a rotation out of bank stocks. So, beware in the short term, even though, I'm constructive over the several-year horizon.
Constructive. Net interest margins look to be rising. I mean, that's a good and a bad thing for banks. Which outweighs which?
Higher interest rates are very good for the banks. The net interest margin for U.S. banks is down 1/5 this decade. It's the lowest level since 1955. All right. So if you're saying, look out for the impact of interest rates on margin, it's been done. And so in our earnings forecast, I think that net interest margins do increase. You don't recapture all of what you've lost. There's been some structural changes, but that headwind has been absorbed.
But they'll have to start paying out again too. That's part of the problem to gain deposits.
Not yet, but the industry has record capital and record liquidity, so we're not at that point. But you're right, at some point over the next few years, you could see more deposit competition, just not right now.
But we could be in a sweet spot for the banks just in the next quarter or so, you're saying?
Yeah, I think we're at a sweet spot as far as the earnings outlook, which is separate than the stock outlook. But you've never before increased rates from such a low level, especially with balance sheets this strong.
How many interest rate increases this year, and who does it benefit most among the banks?
I think that we have about 3 interest rate hikes by the end of next year. That might be less than some others, but Bank of America is the bank that benefits the most from rate hikes. You have $1 trillion of deposits, savings account, checking accounts, and those are slow to reprice upward, even as securities and loans reprice. Does
DoddFrank get changed, repealed, repaired, whatever R word they want to call it in Congress? And is that a good thing?
Let's take a step back, okay? Because you have people who say, get rid of Dodd-Frank, there's too much regulation. And then you have others say, keep it all there. Okay, first I'll say, don't sacrifice one iota of the safety of the banks, but once you secure the safety, eliminate all the red tape. So no red tape, yes, regulation. But the second thing is the people who say, get rid of all Dodd-Frank. Well, where were you a year ago? Okay, that's when we upgraded the banks, upgraded the bank group, upgraded Bank of America, upgraded some other bank stocks, because everyone was scared about the balance sheets. Remember, you had concerns about European banks in Europe and Brexit. That was before Brexit, but it's concerns about that. And investors weren't stepping up to the table to buy these stocks when we upgraded. And people were like, what are you doing? And the reason we upgraded is because we had confidence in the regulation. We had confidence in the resiliency of the banks to absorb not just one financial crisis, but 2 financial crises. And our confidence in the balance sheets gave us the confidence to upgrade the stocks, and that was due to regulation. To regulation, yes, red tape, no. Okay.
Janet Yellen is confident that people are able to lend, and banks are able to lend, banks are loaning out money, and that people are able to get credit. The banks are a little bit annoyed that they're having to, be so handcuffed. Is there just a little bit too much sort of emphasis placed on buffers at the banks?
It's the chicken or the egg argument. Are banks not lending as much, or are borrowers just not borrowing as much? And I think it's been a little bit of both. Banks are looking over their shoulder. When they make new loans, they have to answer a lot more questions from the bank examiners. Why are you making that loan? Why do you have that concentration? And it makes the banks pause. Some pausing is good, but it's been heavy-handed. As far as regulation.
I have to ask about the European banks. They look in dire straits. Some of them, is there hope for any kind of resolution soon?
It's amazing to me. I've been a bank analyst for almost 3 decades now, that the European banks never raised the equity capital that was raised by the U.S. banks, that the balance sheets of the U.S. banks are so much stronger than the European banks. So they still need to strengthen their balance sheets a bit more in any way to catch up to the U.S. banks.
Can we look forward to another book now that you have some free time?
We'll see.